Well, taking a look at trends now, we do understand that over the past 20 years, the FTSE and JSE All Share Index generally do see similarities with regard to their movements. But on the back of the strong earnings season that we've seen in the US, what does all of this mean? To give us further perspective, we're joined by our guest in our Cape Town studios, Skalk Lowe, Portfolio Manager at PSG Wealth. Good to have you with us today, Skalk, and thank you so much for making time for us today. I'd like to start off by getting your perspective firstly on the US markets. To a South African like you and I, why do we need to track them and monitor their performance?
Hi, Gugu, and thank you for having me. Gugu, I think the bottom line is, if you look at let's call it the world economy, America or the US economy inside the world, the global economy, takes up about 25% of the total economy. So the US is sort of a leading indicator when it comes to earnings and also economic forecasts.
On that particular note, though, what's your take on some of the trends that we've seen coming out of the US earnings?
Again, you mentioned there was strong earnings, and I want to sort of call this my favorite Chinese dish. It's a sweet and sour pork, so that kind of scenario. Yes, I think when you look at the earnings that came out already, when you look at 455 companies of the S&P 500 companies already brought out their earnings until last night. And if you look at all those earnings, 71% of the companies did manage to outperform the forecast or the estimates of the analyst. The problem that I've got with those figures, the figures is it's still 2.5% down year on year. And let's just put that in perspective. So that's sort of my sour side. 2.5% down year on year. There's still, let's call it 45 companies that's got to bring out their earnings. If all the companies bring out their earnings and the S&P 500 end the earnings season again year on year down for this quarter, this will be the fifth quarter in a row that they produced negative earnings year on year. Now again, that will be the first time since 2008, that dreaded 2008, where we've seen a run of 4 quarters in a row of negative earnings. So I don't think it's really necessarily good news. I still believe that the earnings is not positive. Looking at the forecast going forward, definitely not positive.
Mm-hmm. Having said that, though, there are a lot of external influences which might be the extra sauces that you add to your sweet and sour dish here, Skalk. On that note, I want to get your view on how South African investors need to react to this news. Is it time to take their money offshore, especially getting the contradicting news and views we get from central bankers abroad?
Okay, you've got 2 questions there. I think we'll get to the rand part first because I do want to do some gloating, But the first question, if you look at the, let's call it the PE ratios, and I know there's a lot of people that say, should the S&P 500 be on a normalized PE ratio of 27 times, or what they're actually producing currently of about 19.4 times? Be that as it may, even at 19.4 times, if you look at the past 5-year average PE ratio of 15.8, which is also more or less what the average PE for 10 years is. And that 19.4 is still extremely high. Let's take it back. Let's take 15 years and we include that last bit of the dot-bomb area, that high PE scenario. Then we're still sitting at an average of 17.6. So, yeah, I think your main answer in one word would be cautious. I think I will be really cautious going into the market now. Second question, Rand. I think a few people thought I was fairly mad in the beginning of the year when I said, well, I think the fair value in the rand is anything between 11 and 11.50. In my Finweek article of April 22nd, I think the rand on that stage improved from about 17 rand to the dollar levels to 14.50. And I had a few questions saying, what's my view now? And I still believe that the fair value in the rand is better, close to the 11.50 levels. So the question is, round about, let's call it the 13.25 yesterday, 13.50 levels, should one be looking at taking money abroad? I think it all depends on your risk profile. It's never a good thing to have no exposure to a specific asset class, and I will include foreign exposure, foreign equities in that saying. So I would say, if you want to start investing and you don't have any investments abroad, maybe wet the toes and go and with a third maybe of your capital.
Skalk, I like your outlook, but to wrap it all up, we've spoken very extensively about equities, but what about diversifying exposure to government bonds, and how does one do that appropriately in a low interest rate environment globally?
That's, Gugu, I'm a bit worried. We sat in the beginning of the year, we sat here and we said, it's not a question of, when will, or if America would start raising interest rates. It was just a question of when. And not just when the first one will come, it's sort of, we were already forecasting 3. Now we're sitting in July and, looking at what talking to the town is, they're saying, well, if further interest rates hike, globally, or let's call it from a Fed perspective, is sort of becoming unlikely. There's even some, economists talking about, interest rate, decreases, which makes let's call it a call for government bonds very difficult at these lower interest rate environment. I think I want to get back and say, when you look at somebody like Warren Buffett, and I like quoting Warren Buffett, he said, never be scared to go and hide in cash when things do not look, or when you don't see any opportunities. I don't necessarily see huge opportunities in global government bonds. And like I said, when it walks like a duck and quacks like a duck, it's definitely not going to be a hippopotamus. I think, for now, the valuations of the market is high. So maybe just not looking too far away from cash might not be a bad idea.
Skalk, I certainly like your analogy of the markets. Thank you so much for your time today and giving us perspective. That was Skalk Low, Portfolio Manager at PSG Wealth.